The sweet green salad chain will debut on the New York Stock Exchange as an iPod in the month of November 2021. The company's market capitalization increased to $5 billion after a 76% increase in share price on its first trading day. The salad-focused fast casual eatery Sweet Green. Even though they had never produced a profit prior to their IPO, the company told investors that their business strategy was robust and that each of its 140 restaurants was successful individually. Since Sweet Green is the latest IT restaurant, incremental gains from opening more stores will soon exceed corporate expenses. Why couldn't they launch 1,000 outlets simultaneously? Why couldn't they replace Chipotle as the industry leader? That's why so many people bought shares on the first day, driving the price up by 76%. After 2 years, the company's stock price is down 80% and it has never had a profitable quarter at GAAP. Welcome to Financial Fortune, the channel where we navigate the ever-changing world of finance and provide you with expert insights to make informed investment decisions. In today's captivating video, we delve into a hot topic that's making waves in the market: the return of overvalued IPOs in 2023. Join us as we analyze the trends, risks, and potential opportunities surrounding these highly anticipated public offerings. Get ready to gain a deeper understanding of the dynamics at play in the world of IPOs. This is Financial Fortune. On Thursday, June 15th, a new Cava iPod restaurant opened in the San Francisco area. Cava might be thought of as the Chipotle of Greece, akin to Sweet Green in flavor. Despite its rapid expansion thanks to shop openings, Cava has never turned a profit. Some have even gone as far as to predict that Cava would replace Chipotle in the fast food industry. In this video, we'll investigate the Cava initial public offering (IPO) to find out why some investors may be making the same mistake twice. Please note that this video in no way constitutes investment advice. For the sake of studying business and valuation, we're only considering Cava. Foreign. Chipotle's successor? Chipotle is one of the most successful fast food restaurants in the world, with more than 3,000 stores spanning North America and Europe. Because they prepare meals in front of the client, they may provide a greater degree of customization than traditional fast food joints like McDonald's. Due to its uniformity, burritos may be produced at a rapid pace, leading to impressive output. The company's achievements have been remarkable. The meteoric rise of Chipotle demonstrated the insatiable want for fast casual eating establishments like its own, which offer fast, affordable meals that are at least somewhat healthier than the overly processed fare offered by chains like McDonald's. Sweet Green is one of the companies in this market. Sweet Green, a brand of quick casual salad restaurants, was created in 2006. It was made with a focus on health and sustainability to attract a younger demographic of customers. On November 20th, 2021, they iPod. They timed it precisely, as this was during the post-pandemic stock market bubble's highest point. In spite of the fact that they were losing money, the company's management team informed shareholders that the company had a solid business model and was already profitable on a per-store basis. They needed more stores to support their corporate costs, but they didn't have them yet. Consider a chain with 3 locations. They have a corporate headquarters and each store makes a profit of $100, for a total of $300. This includes the CEO and C-suite, as well as accounting, human resources, and personnel departments. Say $500 is needed to cover this. Contribution profit of $300 isn't enough to meet operating costs. Hence, you must record a negative operating income. You decide to create 3 more shops, each of which brings in $100 in contribution profit. With a contribution profit of $600, you may finally pay off your business's fixed costs and turn an operating profit. According to the IPO prospectus, new Sweet Green restaurants are expected to bring in yearly sales of at least $2.8 million with a contribution profit margin of at least 18%. That's yearly contribution profit of $500,000 for each eatery. The payback period for opening a new restaurant is less than 3 years, and the initial investment is merely $1.2 million. Investors flocked to this story, giving Sweet Green a market capitalization of more than $5 billion on its first day of trading. However, after a year and a half on the stock market, Investors have seen their investment in the company plummet by 80%, and the company is still nowhere near profitability. What next occurred when Sweetgreen expanded with new eateries? While they saw growth in revenue and contribution profit, they also saw a rise in corporate expenses. It's more harder to manage a restaurant chain with 200 outlets than one with 100. Logistics, accounting, marketing, and other administrative activities become more difficult as the number of sites grows. In 2022, they could have generated $2.9 million in total sales from each store. In addition to the normal costs associated with running a restaurant, food, labor, rent, and utilities, each location incurred an additional $1.2 million in depreciation and overhead. They lose about $800,000 annually each location on average. Profitability is a far cry for Sweetgreen. Urban areas in major East Coast cities like Washington, D.C., and New York City have been the primary emphasis thus far. To grow, they'll need to open locations in the South and Midwest, where customers may be less receptive to a trendy salad chain. That's another indicator that unit economics ought to be approached with caution. Current store profitability per square foot cannot be used as a proxy for future growth. In the same way that a farmer will select the easiest crop to harvest. At first, the most desirable areas become available to a restaurant franchise. Let's assume, for the sake of argument, that Times Square in New York City would be the ideal location for a Sweetgreen eatery. Due to the abundance of customers, the shop's bottom line is soaring. The concern is that having two eating establishments in the same block would cut into business at both. If all the good spots are taken, you'll have to open your restaurants in less attractive areas, which will hurt your bottom line. That's where Sweetgreen runs into trouble. To make ends meet, they'll need to significantly increase the number of their locations, but it's not obvious if the market can sustain such a dramatic expansion. In retrospect, it's easy to see that Sweetgreen's original market worth of $5 billion was absurdly high. The stock market was overpriced in general and interest rates were close to zero. The Federal Reserve's relentless interest rate hikes in 2022 led to a severe bear market. As the economy tightened, investors lost interest in companies that were swiftly losing money. It appeared that investors had finally learned their lesson after the poor showing of Sweetgreen and hundreds of other IPOs in the post-covered boom. However, the impact of this education was temporary. Cava, a franchise of quick-service restaurants, began trading publicly on the New York Stock Exchange in June of 2023. Profitability of Cava. The prices and preparation methods at Cava are quite similar to those at Chipotle. The meal takes its inspiration from Greek cuisine rather than Mexican. There were some eerie parallels between the Cava IPO and the Sweetgreen IPO. The market capitalization of the company increased by more than $5 billion on the first day of trading as the share price more than doubled. This is despite the fact that losses persist at the business. The leadership at Cava has convinced shareholders that the company is on the right track to profitability. They need just set up shop in additional places. Is Cava going to succeed like Chipotle did, or will it fizzle out like so many others? Cava, like Sweetgreen, serves up meat and veggies in bowls inspired by Greek cuisine. Like at Chipotle, diners may choose their own toppings for their bowl. According to DoorDash, Culpa's pricing are a little more than Chipotle's. While the most popular bowls at Cava cost $15, the most popular choices at Chipotle cost around $14.25. Cava and Chipotle are about same in nutritional content. Cava bowls range in calories from 600 to 900. About 700 calories may be found in a single burrito from Chipotle. Given Chipotle's enormous popularity, does the Greek market have place for what amounts to a little more costly Chipotle? Cava began operations in 2011, and the company has grown exponentially since then. Their shop count has expanded by a factor of over 10 between 2018 and 2022, from 22 to over 200. According to Cava, a newly opened restaurant may expect yearly revenues of $2.3 million when it has settled in. Direct retail expenditures account for about $1.8 million of that total. By dividing their G&A and depreciation costs by their total number of stores, we may estimate that each site pays roughly $500,000. We didn't include their one-time costs either. A negative $16,000 operational loss was created for each location. Compared to Sweet Green, which loses $800,000 per location on average, they're doing considerably better. Kava might be as profitable as Gap within the next year if it opened just a dozen additional locations. At the time this movie was made, a share of Kava was selling for $44 and there were 111 million shares in circulation. This stock is worth investing in since the company is worth about $5 billion. Kava must do more than just turn a profit. They must also expand to justify the hefty price tag placed on them. There are currently 263 locations in 22 different states. They predict that by 2032, there might be over 1,000 Kava restaurants, according to their IPO projections. In the subsequent 9 years, would the loss of $5 billion be acceptable if they fail to meet this goal? Chipotle is one of the most successful restaurant chains in the world, with over 3,000 locations worldwide. We hope this video has provided you with valuable insights and a clearer perspective on the opportunities and risks associated with IPO investing. Remember to like, subscribe, and hit the notification bell to stay updated with our latest videos. At Financial Fortune, we're committed to keeping you informed and guiding you towards financial success. Thank you for joining us today. Until next time, may your investments be wise and your fortune thrive. This is Financial Fortune, signing off.